Are we ready?
Yeah.
Well, very good evening to everyone, both of those present in the room and also those with us virtually. Roughly how many do we have, Ladislav?
9.
9. No doubt more will join as we proceed through the evening. I have a general word to say, which is about rebirth and new life in an interesting way. Peckham, which, as we all know, was created by Max Watson, from the ashes of Peckham rose phoenix-like the UPEP. And now we have another stage of this pattern of life, which is Charles's book, which is most appropriate for this UPEP occasion. And this will make sure that messages on political economy and what its value is and how it should be looked after will continue for a long time. And I think it's a very important book. And I hope and trust it does extremely well, despite the rather stiff price. But obviously the publishers valued it, as I'm sure we will do. I think that's probably enough from me. So I think, Charles, let's get you started. And just everyone in this room remember that there are quite a lot of people out there. It may only be 9 at the moment, but it will be more than that shortly. And I think what we have to try and remember is that all the machinery is sort of up there. So we have to do a bit of projection. And as Julie always reminds me, it's no use looking at the screen because people aren't there. The camera is up there. So, Charles, the floor is yours.
Thank you, Dave. Thank you, yes, to everyone who's here and everyone who has joined online. I'm very pleased to be here. Also, thank you for, I guess, the ESC for hosting the work which enabled this book to come out in St. Antony's. And also previously we had a very useful workshop here, which was very useful for this. And also there was a big conference on a number of these issues in January 2020, and that appears as an annex in this book. And again, it's all been helpful sort of collegiate work to bring all this together. So please, and also thank you to Julie Adams for arranging for this particular event here. So moving on to the book, should we go on to screen save? Right. So just explain the title. I mean, it's Europe Beyond the Euro, Keeping Europe's Economies Safe in a Time of Risk. Particular work.
Yeah.
Yes, indeed. So the Europe Beyond the Euro. The point of this is that much analysis of Europe and of future European integration and so on focuses really on the core countries, the sort of Franco-German, which is valid in many ways. But there is also a wider area. It's outside, I mean, in the EU, outside the Euro area. And there's basically 200 million people who live in Europe outside the Euro area. So we're talking about the future of Europe. Even discussing European integration and so on, it really is more than just the core of the core. The second point really is that creating and preserving the euro was the major EU issue for the first 20 years of this century. The euro came into being by 1999, and then it went into crises and we had problems to try and preserve it, with much thinking that in fact it was under threat. So that's no longer the central issue there now, probably. Also, the analytic issues. If we're looking at the future of Europe, it's not just currency union, but it's wider analytics we look at now. And there's also one of the original topics I came here to do was governance issues. At that point, it was how can we be sure that it's not the euro area which determines everything for the future, rather than a diversity of experience and other countries still having their input. I mean, at that stage, it was 3 areas of the EU: it was the UK, Scandinavia, and the Central East Europeans, each of which could have been, I mean, together outvoted by your area. So how much can you have a governance to protect the others? And the other point is Europe, beyond the euro, is Europe is in a dangerous world, and it has to the area of sort of relative homogeneity within it. So if one's trying to analyze, so what one analyzes within the EU, just giving now just a few tables, numbers, just to show the time of risk, I think. Yes. Okay. Do you want to, can you pass it on? Yeah. Yeah. Maybe Vladislav can do it as safe for me. So just the other part is Europe in the time of risks. I mean, this is largely self-evident. There are a whole range of risks. It started off when I was first here was just the global financial crisis. And now I think around us, we see the COVID-19 pandemic, climate risk, there's cyber risks, and then even crises we hadn't expected, which is how most crises are, supply crises, that we couldn't get petrol and other things are not supplied. And there's political crisis, the populists of Poland and Hungary and elsewhere. Not all are directly financial crises, but all have financial interactions. There was a very large stock market fall last Friday when it was realized there might be another partial lockdown, because the COVID goes very quickly onto the economy. And conversely, financial problems have in a number of countries been seen as the causes of the populism the last few years. Now just a few slides just to show really what I've meant about why crises really are affecting the future of Europe. Here we see the impact of the global financial crisis on 4 of the economies. I have some others on the next slide. And you can see here that all of the countries lost GDP. This is real GDP. And the crisis started then in 2008, and the economies all fell. The fall was less for Germany and slightly less for France, and they rebounded. But if you look, Spain went into a decline really for about 8 years, although has recovered quickly. And Italy, even now, has not, or this ends in 2019, just before we have the next downward shock from COVID. So this was as far as the recovery had got to by late 2019, and Italy had not even then recovered back to its level of 2008. So the crisis could seem to have given it lost it 10 years of growth. The next, please. And the next one shows this even more markedly. You see the Latvia, for instance, it's the gray line, has a very rapid fall. They're hit very early on, about the largest fall, and then a very major rebound. So this is an economy which is basically infinitely flexible, whereby it immediately was massive cuts in salaries and everything, and off it goes again. It's this very small, very open economy with a large part of its population in a diaspora. On the other side, then we see Hungary slow down and then the growth revived again. Italy, as mentioned before, doesn't recover, and Greece is still back in real terms below its level of 1999. So we see the impact of the crisis across many of the countries of Europe. Next, please. Just here, I mean, a little bit more, just, well, it takes so much time, but you see again, all of them are affected. Go on to the next. The next one really shows the various countries relative to Germany, because part of the point of the European Union is convergence, and it's meant to be fostering convergence. And for much of the time this works, but you see that actually there is a reversal in the convergence process, even here for the Baltics, which are the most rapidly growing and least problematic in some ways parts of the EU. the convergence process sort of, fell back for several years. And if you look at the next slide here, the top line there is the Czech Republic, for instance, and Czech Republic was moving very well towards convergence by the start of the global financial crisis, and then fell back, and so was basically growing more slowly or declining more rapidly than Germany. And even by 2019, its position hadn't recovered by 2019, its position relative to 2008. So this really shows again that the impact of the global financial crisis on Europe and on European integration. The next two slides, I'm not sure if everyone can read them. It just goes into country by country, which shows when the countries had their pre-crisis peak and when they recovered. So just the first one, Austria had its peak 2007, fourth quarter, and didn't recover until 2015. So really 8 years of a reduced GDP. So the next slide sort of shows several and never. You have some nevers in the second columns in that slide, which is basically Italy and Greece and Croatia did not recover their 2007, 2008 positions by 2019. So this is it. Let's move on to the next one. The next one, then I just compare the global financial crisis to the COVID crisis. So the first column here shows the maximum fall from the right-hand side shows the fall from the last quarter of 2019 into the second quarter of 2020. So the 2-quarter fall as COVID hit and as all the economies went into lockdown. And you can see there's a range, because for Austria, for instance, the first one, the GDP had fallen 10% in global financial crisis, it fell 17% with COVID. Others also, France fell 7% in the global financial crisis and 20% with COVID. Others there was a reversal. Latvia had fallen 35% in the crisis in the GFC, and then only 14%. So I think that's probably enough of the numbers. So I'll just briefly outline what I'm going to present now and show what this is. Firstly, the first part is on the global financial crisis and its aftermath, essentially what institutional measures were introduced and where there are still gaps. Then it switches particularly to financial stability, which is really the focus of this, and the instrument to manage financial stability, which is macro-prudential policy. Then focus on the ESRB. Apologies, this may be an alphabet soup, the European Systemic Risk Board. The book has 3 pages of acronyms at the beginning, so I will try not to talk in alphabetese. But the main one to try and remember is the European Systemic Risk Board, which is really one of the main focuses of this. So then look at the weaknesses of the ESRB and recommendations to enhance it. That, in a sense, the book might be divisible in a way into 2. That is really global financial crisis and financial stability, and that's a homogeneous group. And they then broaden it to the overall institutional structure of the European Union and how the ESRB would fit into this broadened structure. Firstly, the broadening the range of risks. So it's not just financial risks, but it has something to say on all risks. We look then at differentiated integration, so internal differentiation, external differentiation. And in fact, the argument is that the ESRB would be an instrument of external differentiation because financial stability knows no boundaries, and the wider you can have it, the better. Inequalities and compromises in the EU. I mean, one of the themes here is that some of the countries, some of the member states are more adversely affected than others, having come in late. I mean, the point being they weren't there for the earlier treaties. And so that's an element. Then come into the Bruegel model of the European Union. How can one actually handle all this? Here, for those who were here and heard the second Max Watson lecture, this is what Thomas Wieser presented from the Bruegel Institution there. And then the final bit, the question of treaty change, which is somewhat contentious and I think less consensus driven. And I think the SRB, I think there's a case which I think is pretty overwhelming. But as we come to treaty change, it's on the one hand, on the other. So next one, response to the global financial crisis. What was major achievements in enhancing the regulatory agencies? The European Banking Authority, the European Insurance and Occupational Pensions Authority, and the European Securities Market Authority. These were all built up from much weaker agencies before, and then you've got full regulations. You've got the single market in the EU, and the single market needs a single regulator. So these were established with a mandate to produce a single rule book at an early stage. That's a major achievement. Tighter capital standards. So it was realized that the banks are actually incredibly weak because the numbers of the requirements were low and there was a weak definition of capital. So Basel III and various European transpositions of Basel III to a European context raised the level of capital and tightened the definition of capital. Systemic buffers, they introduced after the crisis certain institutions are systemically important, i.e. governments can't let them go bust, and they therefore need to be more protected, have higher capital. Finally, resolution recovery frameworks. A lot of countries are complaining they've messed up in the global crisis. They didn't have a proper legal framework to deal with it. And so here we had a whole range of directives and regulations coming from the EU, so six letter, 2-number acronym, which I won't give you. Then halfway through or towards it, as the euro crisis was very serious, the European member states announced the prospective banking union, of which the central element would be a centralized supervisory authority at the European Central Bank. And there's also increased powers for the establishment and enhancement of the European Stability Mechanism. And a number of us heard the head of the ESM, Klaus Regling, giving the third Max Watson talk earlier last month. So that's again, there was this was intended to provide finance for countries in difficulty, but had very severe conditionality, and many of its measures were never actually used because the conditionality was too severe. And in fact, as it was being wheeled out at the start of the COVID crisis, and it was thought Italy needed money, the Italians said, okay, but we're not going to touch the ESM because we don't want the conditionality. And finally, there's financial stability. The European Systemic Risk Board was established, which is what I'll talk about for a few minutes. So that was another element from it. There's next one, unfinished business from the GFC, finishing the banking union, and everyone talking about future of Europe is complete the banking union. And what often people focus on is a common deposit insurance fund. This has been proposed for several years, but it's sort of blocked. Largely the Germans are worried that this is basically them financing weak banks elsewhere. There's concern of a transfer from union. There's also steel plating the banking union. I'll come into this. Wolfgang Schäuble, the then German finance minister, was upset at the way that the banking union was being introduced. And he said it's just timber framed and it may not survive big storms for reasons to go into. And at some point, there's the option of steel plating. And then refining resolution recovery framework. This has not really been tested so far, and there's lots of arguments that it cannot deal with a systemic crisis. It's okay for an individual bank. Next, unfinished business, capital markets union. This had been pressed very much by the Brits, and the last commissioner appointed before the referendum, Lord Hill, had been appointed to take forward the capital markets union. This is expected still to go on, although slightly less rapidly. Insurance union is not really on terribly many people's radar and focus on insurance, but it is a very major part of the financial sector, and it's more interconnected even than banking. So, I mean, one of the minor things that this goes into is on that. And enhancing the financial stability framework, which is again an element here. So we come on to macro-prudential policy. The next two chapters, the next parts that are the two longest chapters in the book, actually, the macro-prudential policy and the European Systemic Risk Board. So macro-prudential policy, and here you probably have a split between the experts who find this very basic and the people who are not expert who find this a bit heavy. But that's partly of it. The macro-prudential policy is relatively unknown except the professional, which may be an advantage. It's not toxic. I mean, so many other things really toxic, and then there's sort of misinformation, and you can't do this and you can't do the other. But if nobody's heard of it, and nobody's heard of the agency, there's scope possibly to do things. Macroprudential policy really developed after the Asian crisis. I mean, after every crisis, there's all sorts of, post-mortems. And they worked out that really the governments didn't know what was going on. They were getting mixed signals. So there was the start of macroprudential policy, which essentially is the recognition, it says up there, that macro indicators and policies are not just the aggregate of the micro indicators and policies. For instance, one bank growing rapidly is a sign of great strength, but if all the banks are growing rapidly, this may be a sign of imminent crisis. And basically it's about the strongest lead indicator you can have. So you need to be looking at the aggregates, not just looking at the individuals. So a lot of analytic work at the Bank for International Settlements, at the IMF, really from what do we mean by this? What are the indicators? What are the policies? But nothing much really happened until about 29, until there's the great moderation. Everyone thought that we're in a safe world and nothing was needed. But then after the GFC, there was a big interest. As far as the EU is concerned, it's split between the national and EU competencies. I mean, partly because people didn't super prioritize it. So a lot of this is still national work. But there is the EU competence, which is in the ESRB. And just there was a reluctance to establish completely new institutions for this policy. So they're basically put into other institutions, or they're set up in committees. The Americans have this committee, the EPSOC, which brings together the Fed or the other relevant agencies to meet together rather than having a distinct committee. Next one. So anyway, there's lots of institutional innovations as to who should operate this policy. Mostly it ends up in central banks for a number of reasons. I think in the Eurozone, it's partly because the central banks had lost their monetary function and they wanted to have something else to do. And in others, it became, as in the UK, you have two wings. You have a monetary stability and a financial stability wing, and they're seen together. And although this is obscure, shown that it's, some people saw this as very important. And Mark Carney actually chose to discuss the Bank of England's macroprudential policy in his very final speech, sort of a headline speech, as the Bank of England governor, under the title of The Grand Unifying Theory and Practice of Macroprudential Policy. So really implying, following from physics, that if you get the macro pru right, then you've got this unifies and brings everything together. My handout stopped. Maybe you have a long. No, I've got one for the.
Yeah.
You may have. I can.
Or your book's not like that.
My book's not like that. Lots of empty pages. No, this looks thicker. This is fine. Anyway, the European Systemic Risk Board was established 2010 at the same time as the enhancement of the other sectoral agencies. And it's unlike, for instance, the European Central Bank, which is only for Euro countries and only for banking. This is for the entire financial sector and for the entire membership of the European Union. It covers all national supervisory authorities, and apparently this is where the country's insurance supervisor talks to the country's banking supervisor in some cases. It brings it all together. It also has the European Commission is represented there, the various agencies are there. So there's at least potentially 3 representatives per country, and the regulators, potentially 81 national representatives. And this is sort of leaves itself open to ridicule. There's sort of various people, sort of articles, how can they have an agency with a committee of 81? It can never work. and sort of this and I mean, if you want to make fun of it, okay. But the point is that there's the inclusivity in it, and it does have ways to work within the 81. There's a small secretariat, an executive board, an advisory academic committee, which used to be headed by Jonathan Portis. I mean, it really got serious outside advisors there. An advisory technical committee who are basically second level central bankers. And unusually, there's a complex voting power structure that includes letting the academics have a vote on this, which again, it's more inclusive. This was the European Parliament who was concerned this would be too central bank determined. So as this went through the various processes, they added in the side of the academics. And it's a balance between the inside Euro countries and the outside Euro countries. So the head of the ECB is the president of this, and the deputy head was previously from the UK and is now the governor of the Bank of Sweden. So it is explicitly at the highest levels. It is not just a Euro agency. So the next one, it has soft powers. It doesn't have any powers. Its powers are warnings and recommendations. The countries have to comply or explain. And the warnings, recommendations can be public or private. And arguably the ones which needed most to be public are the private ones because people are nervous. I'll show you in a minute, there is sort of a dashboard as to how they respond. So the government, initial work was on the risks of households' foreign currency borrowing. So immediately after it was set up, it was spotted that the whole of the new member states, there was massive household borrowing in Swiss francs, because we were, great, Swiss francs, only 1%. And of course, hadn't worked out that the Swiss franc can sort of double in its value against the euro. And so there was a lot of warnings of this, and actually was quite successful in getting the country to take measures. More recently, pre-COVID, most of the work has been on real estate risks, which is really, I think, where most macro risks are from, both the commercial and residential real estate. And it's a vehicle for reciprocation on national macroprudential policies. In that, if, for instance, say the Dutch decide they've got a problem with their commercial real estate, they can they have powers over the Dutch banks on what to do with it, but they don't have power over EU banks which are branched into the Netherlands. So you go to the ESRB and you say, look, we have these problems in the Netherlands. Please, dear Latvia, your banks are sort of lending into Netherlands. Please do not encourage them to subvert our things, and we would like reciprocation. And that is a big part of, in response to national policies in a very open banking market where you get a passport in one country, you can operate throughout. And so that is an ongoing element, is to have reciprocation, which again is voluntary. And one thing in their record, there's quite a bit here in the record. One thing is they're not intimidated terribly by the large players, as opposed to other parts of the Commission where you see that the Germans missed the growth and stability pact, so what you move on. But here you find quite a number of the warnings and the recommendations are actually on the old member states. So the risks on the real estate really seen in Germany and France as well as the others. The next one, next is just a slide of just the organization of the ESRB. It shows the headship and then the various committees and so on. The next one is just basically the color coding. So if there's if a recommendation is given, then the dashboard is created. So if a country responds and does everything perfectly, it's a green. If it says it doesn't have to do it because it's not affected and everyone agrees, it's a blue. And then the various degrees of non-compliance are sort of orange down to deeper red. So you can sort of see when these things are published. They are generally on the website if you want to look up. You can see these various dashboards, which do show sometimes it's embarrassing that some countries sort of, Germany is red on various signals and Bulgaria is blue, and so on. So that anyway, so that's it's an interesting and accessible way to see how countries respond. So the European Risk Board. So it's got 10 years of achievement, and I think its biggest achievement is that nobody's heard of it because there's dogs that don't bark. I mean, if you preempt a crisis here, you may have this, and everyone takes measures, and okay, you've never heard of it. There are issues though, and this is one of the things where there could be recommendations. Firstly, there is no dedicated leadership. The head of the ECB at present, Christine Lagarde, is busy with monetary policy. And I've spoken to the SRB people with the two previous heads, and they said that, to get Trichet or Draghi to show much interest, they can maybe turn up to this meeting. But running monetary policy is a full-time job, and that therefore it's delegated, and also it's not a fantastic signal if you can't get the headship there. So it's unusual for a major institution not to have its own president. It's also physically in the ECB. It's got certain flaws of some of the ECB, and the contracts, the personnel contracts are linked to those of the ECB. Also, its IT is dependent on the ECB, which is not such an issue. But overall, in some ways, the ESRB supervises the ECB because it is it's a regulatory agency of a part of the financial system. And it's a bit funny that the head of your agency, the head of a supervised agency is the head of this agency. So maybe some issues there. Also, soft power is great in some ways. I mean, maybe that's why they could criticize the Germans and the others, because so what? And you get through a lot of decisions because so what? But on the other hand, maybe soft power isn't enough, particularly in a crisis. And also, it's removed, as many of these regulators are, it's several degrees removed from the actual players. So the ESRB has to go to something it wants to do on banking. It has to go to the European Banking Authority. It has to go to the national authority, not the ECB, in order to get data from countries. So there's lots of slips in this way, which in practice they say has not been a problem so far. Doesn't it? And the other thing which I find quite significant is very limited international representation. When they go off to the Financial Stability Board or IMF World Bank meetings or whatever, the ECB goes there. And the ECB is the representative and it's ECB teams. And financial stability is therefore represented by often the ECB, and they have their own meetings. I mean, Vitor Constancio, the former deputy head, was very active, very positive on this. But I mean, he represents part of the financial sector, so there is limited membership. So the following, you come to recommendations, which are self-evident from what I just said. You appoint a full-time president. This had been proposed by Willem Bouter to the Treasury Select Committee in the UK some years ago, but it wasn't done. You move from the ECB, possibly out of Frankfurt, and you separate the staff from the ECB, which may require actually looking at how you finance this thing, because at the moment it's just essentially financed out of the ECB. You give it some hard powers, for instance, reciprocation. It seems a bit odd that it's voluntary to reciprocate. Some countries, such as France, automatically agree every case of reciprocation. Others have a rather mixed record. You grant direct access to national bodies. I mean, if this body thinks it wants to know what's going on in Belgian banks, it should be able to tell. So, and you make explicit ability to make subnational recommendations and warnings. And this is an idea of how you take Europe, the EU, beyond the union of states to European peoples and of sub-economies. I mean, we see also in COVID, and you also see this, that sometimes the nation state is not the right body to be taking these measures. You could, for instance, imagine that in capitals, there may be commercial real estate problems. You might wish them to give warnings about what's happening in Vienna and Frankfurt, and it shouldn't be in the hinterland because there are different things in the hinterland. And so they do have this power, but it's not explicitly in an article, and they've never yet actually used it, although they have thought about it. And overall, this would establish the ESRB as an apex EU institution, which people might have heard of. And you can change the acronym. I think there's some in there which slip off the tongue a bit easier than the ESRB. And it would actually be there when you have Eurogroup meetings and others, rather than being represented indirectly. That's sort of self-standing, and that's really a body of recommendations creating financial stability. So, but now I sort of go wider into the wider world, which may be, I think, more contestable. So this is basically that up to now it's basically enhanced financial stability. This is a gap. Let's reduce these constraints. The first one is really the ESRB can have a role to forewarn and mitigate other crises, such as pandemic, climate, cyber, and supply chain. Not that that it has expertise in any or all of these, but all of these have financial implications, and would be a very useful forum to have, say, the specialist agencies come together, work out this is where we reckon there are risks in this regard, and let's balance it. What's the economy? Do we plan to close things down? What are the best things to close down if we need to, and so on. So again, that's basically that there is a role for central agency. What we've seen up to now, that in fact, well, I'll come on to this in a minute, there had been war games in a number of countries. We are bound to get a pandemic at some point, and now they dust them off. And gosh, we looked at this 5 years ago, it was never looked at. If it were actually in a transparent body such as this, and it's part of a regular process, you couldn't have people just not bothering or governments finding it embarrassing, so we bring it forward. Anyway, just to give examples, after COVID-19, there were immediately a whole range of macro-prudential responses. Interest rates everywhere were cut to zero. Counter-cyclical capital buffers, which have been raised because of concerns of real estate, were put down to zero. Dividend limitations, voluntary and some ignored, were imposed. Limits on sale of investment funds. This is one form whereby triggering ratings, could actually cause further sales. You could have an implosion of financial markets. And so limits were put on that immediately. Regulatory inspection, stress tests were postponed because they wanted really all the agencies to work on the emergency measures to counter the impact of the crisis. Fraud and enforcement actions across the range, such as, for instance, for households, no evictions, and credit guarantees were introduced. So the next one's the lessons from this. As I just mentioned, there had been war games in various countries, including the UK, but these hadn't been taken anywhere. They were never published, and it's just a sort of technical exercise. Also, various risks had not been spotted, but just-in-time supply chains. We thought, hey, everything. Now we see the problems of just-in-time supply chain. If you can't travel from one place to another, that you don't get the supply. And people are really supply chains only became really apparent. And this is something one can look at. The macro crew, which up to now was just on the financial sector, maybe one needs to be doing also similar work on the corporate sector. Share buybacks, for instance, carried risks and were therefore, stopped for a while. For instance, it was seen that the major US airlines, for instance, had bought back about 95%, had used 95% of their profits for the previous 10 years to buy back their shares. So you have these hugely indebted organizations with no cushion whatsoever. So as soon as there's a downturn, they immediately have to come to the public sector for support. We have Hertz, which basically the cars are a front for a private equity firm. They're the collateral for the private equity firm. As soon as airports are closed, the value of your collateral, the cars, goes down. So the bankers start calling in the debt on the private equity firm, and Hertz goes into Chapter 11 in the US very quickly. So there's a whole line of things which one only understands when one looks at this crisis. And there's there is at the moment, or has been, no overall assessment to bring together the macro-prudential and the various other risks. And if you have an independent assessment, they would hopefully identify some of these in advance and would assess the costs and benefits. As the economies open again now, to what extent do you relax the constraints? To what extent do you allow everyone to pay out maximum dividends, even if you've got no cushion, and so on? These are issues which will need to be addressed to make sure that the recovery is sustainable, not just build back better, but build back safer. Okay, so climate change, macro-prudential policy, climate change. Again, Mark Carney was very much at the fore on this, and he thought climate change is a tragedy of the horizon. all the rest of the policies, so it puts it in the same framework as overall macro policies, but other policies you do over a 1 to 2 year basis. You raise taxes this year because you have a shortfall this year, or interest rates this year because inflation is going up this year. And therefore, however, introduced you need to be looking much further ahead. And again, there's the issue of possible inconsistencies of macro-prudential and monetary policies. A number of countries have found this, as the former has a much longer time horizon. The Bank of England would allow inflation overshoot under certain circumstances when desired macro-prudential policies are inconsistent with monetary policies. And this means that the macro-prudential policies need to have standing, and the people pressing them need to be able to argue against the monetary people. And it's generally thought in Europe it's the other way around. If you've got a monetary issue and you've got the macro-pru, it's the monetary, and you were worried about inflation. That's more important than, we may have climate crisis in some decades. And again, to having a single agency to reconcile these would be a helpful way forward. Also, there's the other problems that we have with climate change is that major structural changes always carry risks. In this case, we've got the legacy assets. I mean, if you've got coal mines and things, they're going to be worth nothing fairly soon. So how does one value that? How do you value pension funds or whatever, which may have large holdings of prospective legacy assets? So how do you manage the transition to a green economy, really? How do you make sure that portfolios of pension funds and so on actually move smoothly towards what will be needed in the next 20, 30 years? At the EU level, it's not clear these risks or any level. These are being holistically addressed. And really, the ESRB really, for in a time of risks, really to have a central agency would be helpful. Now, not all member states move forward. Come now to the overall EU and how does this fit into the EU? There's a wide academic literature, which I was introduced to here, on differentiated integration. And one of the points is that fewer than half of EU initiatives since 1990 cover exactly the EU membership. And this again is a contrast to, say, the Brexit people who think of the EU as a behemoth. In fact, if you look issue by issue by issue, and a wide range of them, are not, they're not comparative, don't cover everyone. And some of them are attractive and go wider. And amongst the ones which with internal differentiation, there's the euro, there's monetary policy, and there's the banking union. So the banking union only covers as mandatory, it's only mandatory for countries in the EU, in the euro area, and it's optional for all the others. And I think none of the others have yet joined. You also have enhanced cooperation, a specific proposal specific policy in the EU that if you can get 9 members to agree something, you can take it forward. There's a number of areas, in some areas of divorce law, for instance, where you have a minority wish to do something within the EU framework, they can do it. And so it doesn't, there are ways in which you move forward. And Emmanuel Macron said differentiation can contribute to a stronger European Union. Let's embrace differentiation, the vanguard, the heart of Europe. And he goes on to another bit, which actually was picked up in The Observer yesterday, where they quoted this book, because it comes on after a long spiel about how this would work. It then says, if we have a Europe on this basis, it will even have a framework which at some point, if it wishes, the UK can rejoin. People say, oh, we can't rejoin Europe because everyone will have the euro, they'll have this, and the other. But in a macro model with differentiation, there's no need for the ever closer union for the membership. So the external differentiation, just coming up with that. In a number of areas, EU initiatives are more than the EU. For instance, the Erasmus program, and a number of these other ones, which actually post-Brexit, the UK was offered to remain a member of, like the Europol and these others, but the present government decided not to. There is no reason outside that you can't belong to the Erasmus program and students can travel as they have done up to now. There's also de facto external differentiation, because the EU is a single market and its standards therefore have very great international importance. And there's a very good book by New Bradford. She presented it here last year on how Brussels rules the world, is that they look at the regulations which come through, and then countries around the world still follow them, because if you want to do business in Europe, you need to have the same standards. And I know some work I was doing about 5 years ago in Latin America. The Latin American countries were waiting to get Solvency II, as the insurance standard, before they did anything on their side. They would then try to write their regulations as close to Solvency II as possible. So there is a single market wider than Europe, so there's external differentiation. There are also regional groupings which work on this. The Nordics are the most obvious one, which is the Euro country Finland, the close to Euro country Denmark, the non-Euro country Sweden, the non-EU country Norway work very closely together. So you can have this. And Vienna Initiative at our conference in 2020, we had a whole session on the Vienna Initiative, which is a sign of external and internal differentiation. So some countries which find it interesting are there, both inside and outside, and also public-private and so on. Basically, you have external differentiation where there is a common interest between members and non-members. So we come back to the ESRB, and the ESRB, its record, it has progressively incorporated the non-EU EEA members, so Norway, Liechtenstein, Iceland, which therefore it's not inconsistent with the formal rules, but de facto they've managed to do it, partly because of Nordic leadership. So you find that they participate in everything, except they're not allowed to vote. That's a formal bit. And even when the ESRB does risk-focused analysis, it includes Norway, even though it may exclude lots of the internal countries. So they really are participating there. And we can look and think, financial crises, COVID, all these other crises, they are not really stopped at the border. There is a clear contagion, whether it's financial or health, across the EU border, and hence, arguably, if one is working in these areas, there is an argument, therefore, for this would be suitable areas for external differentiation. The accession countries are amongst the most obvious ones. All the accession countries are very interested in financial stability processes, and there are, a lot of informal discussions between the Western Balkan states and the EU states through the ESRB. And again, this could be sort of semi-formalized, as with the EA. Ditto, if we're looking again at the UK, if you talk to anyone at the ESRB, they say the UK had been just about the leading element there, with the Bank of England people very involved in drafting and in focusing on it. And the UK financial sector clearly is still heavily involved and interrelated with the European sector. So if you have external differentiation, there's no reason really, with people, if everyone's willing, why the UK couldn't be participating on this. And the ESRB is clearly not the only one where you can have external differentiation. Also, the ECB, the European Centre for Disease Control, is an obvious one. They do have a certain amount of external differentiation. They also have the EEA, and I think they also have Switzerland in a number of their areas. In their data areas, they collect Switzerland. So there is an argument, therefore, for external differentiation. And then we come on to, well, how does this fit into Europe? And here we have the second Max Watson lecture explained this to us. Since 2014, the Bruegel Institute. So these are the core of the Federalist Europeans. So it's not even people from the fringe Brexit thinking about this. There's a Bruegel model for the messy rebuilding of Europe, which they put out after the global crisis. And what they have is that they suggest that most of the EU's functions should be divided into about 4 pockets, which member states can choose or not to choose. So you have economic and monetary union, you can join or not join. You have defense, you have Schengen immigration, so people want restrictions on immigration, but they really want to be members of Schengen, so you may be able to get them to trade off. And you can just around there, and you just have a bare bone structure. And what they put in then is the single market and basically the rule of law, the European Court of Justice. And that's all you need. If you sign a single market, then that's it. And the rest you can choose. And they have a model how this actually is likely to attract and retain more people and be safer than the single undifferentiated model. I mean, there are issues here that some countries don't even accept the rule of law in BCJ, and also some of these pockets are not homogeneous and can be used. But I mean, nevertheless, this is an overall framework which could be useful. And in my view, you could add financial stability and public health to the superstructure. They are really critical to the lives of Europeans, the sustainability of the EU. And therefore, I would suggest you have the ESRB in the superstructure. It safeguards the stability of Europe, potentially also those close to Europe. And again, with external differentiation, you can have this agency to try and have financial stability, also with public health, a similar argument, really as core elements for the future of Europe. And finally, now, do we want treaty change, which I know is deeply contestable? And again, I quote Emmanuel Macron. The German taboo is financial transfers. The French taboo is treaty change. Ultimately, if we want both will happen. I want to assure everyone of that. But we will stop being afraid of the people. I mean, the financial transfers taboo, arguably, was ended last year when the Germans agreed to the New Europe funding in response to COVID. The treaty change has not yet happened, and I mean, who knows when. There's fear of treaty change. There were major problems last time round with the Lisbon Treaty. Treaties have to go to referendum, and Ireland, France, Netherlands have records of voting no in various referenda, and might do so again. And there's also, even more significant, the fear that some members will raise extraneous issues when you've got Poland and Hungary in the EU at the moment with their own agendas. They would like to look at things which others would like not to. And also, very many of these elements discussed here can be taken forward without treaty change. I mean, a lot of it can be done. It does not need treaty change for all of this. However, on the other side, the measures so far have involved fudging of the treaties, which may have run its course. Vivian Schmidt, who spoke here, I think the ESC, in the last year, has argued strongly it's run its course. It is great, very clever. Bureaucrats, fudging everything is compatible with the treaty, but at a certain level it ends. Wolfgang Münchau in the FT has argued this. And one sees this becoming apparent in the German Constitutional Court, where last year they did challenge, for the first time, that measures at the EU level were disproportionate and were asserting the rights of the German courts over European courts. So there are sort of warning signals in that side. The other part is the timber frame banking union of Schäuble, which is that the bank supervisor is in the European Union, is in the European Central Bank, because they could do that without treaty change. Because the ECB law says the ECB can do anything else if it's thought to be useful so you could do it without needing to go to treaty change. From Schäuble's point of view, it is not terribly safe there, because a monetary agency should be a monetary agency. You do not compromise the monetary side. And there are all sorts of Chinese laws within it to try to prevent it. But nevertheless, if you're a real purist monetary person, you want a monetary authority to have one objective and not compromising it. And similarly, so you're not safe on the monetary side, you're conversely not safe on the financial side. So, if you have a new treaty, you can put the single supervisory mechanism somewhere else. There is also unequal treatment between the old and new member states. Anyone who joins has to accept the full acquis, and the acquis, of course, got longer and longer. So that maybe it's not fair on those who join. For instance, at Maastricht, the UK and Denmark got opt-outs. Others who might have liked opt-outs don't. And formally, at least, they have to join the euro as soon as they have met the criteria. Also, one would say some of the parts of the treaties are deeply obsolete and, in a sense, reduce the credibility. One of the Maastricht criteria for joining the euro is that the member state has a debt ratio of less than 60% of GDP, which was okay in the late 1980s. But as of 2019, i.e. before the massive increase in debt with COVID, 13 of the 19 euro area member states had debt ratios above 60%. 4 had ratios over 100%. And conversely, 6 of the 8 countries outside had debt ratios below 60%. And so the grandfathering means that the present euro area people are in there, but using these objective economic criteria, their positions are worse than some of those outside. So maybe one should look at them, or should flexibilize them, or maybe do something with them. It's also arguably, it would be timely to refocus now on issues of central importance: financial stability, pandemic management, climate change, and the unknown risks. And if you actually look at these rather than some of the more esoteric things from the past, this would serve to generate knowledge and awareness and ultimately hopefully support for Europe. And also there is an ongoing conference on the future of Europe, which the proponents hope will have some radical proposals. And if they're radical proposals, one would expect they would need to be put in some treaty. So anyway, that is open to question, but I think there would be some case for it. But would not hold up the arguments for more of the ESRB to say that you need a treaty change for it. You don't. I mean, most of those earlier proposals would not say to do. So finally, the summary recommendations. Firstly, I'd say it's not necessarily depressing or negative to recognize the risks and try to deal with them. It's not saying, gosh, how depressing, just think about this. It's just, guys, we should insure ourselves. There may be these risks, we may have cyber risks. Let's at least go through these and make sure we are confident that we have a high quality agency which is trying to protect us for them and has got policies in the event these materialize. Complete the post global financial crisis reforms. It is generally recognized reforms are not complete. We heard from Klaus Regling his suggested ones. He did not mention the financial stability, but I dialogue with him and sort of agrees financial stability is important and ESRB should be. So it's not inconsistent with anything. It is a gap, basically. The ESRB, I think insurance is another gap, which I haven't gone into here. And so they give the ESRB wider visibility, providing with standalone positioning at appropriate international fora. So if they appear at the annual meeting financial or in the various EU fora, that would of itself give it standing. And broaden its remit to protect economies more widely, to forecast, mitigate, and manage risks beyond those in the financial sector and beyond those even in the EU, insofar as there is contagion. And insofar as you're training the West Balkans for ultimate accession, you want them to already have been brought into some of the institutions as far as you can. You use the insights from differentiated integration, position it as an agency of external differentiation, and recognizing the risk of the centrality of risk management to include the ESRB in a superstructure of a broader. Thank you.
Thank you very much. Well, thank you for a stimulating gallop across some tricky terrain. Thank you very much. I'm very conscious that the people watching virtually can't actually see the people in the room. So I can assure them that there are various categories of people in the room. Friends of Max Watson, friends of Petham, including David, who is more than a friend of Petham, friends of UPEP, and the great and good of the political establishment and political economic establishment in Oxford. So congratulations, Charles, on attracting such a very high turnout of audience. Let's have some Q&A. I think we'll start with Q&A from people here, and then with Vladislav's help, we'll find if we're getting any from the outsiders, who will then, of course, become insiders. Right. Any immediate questions, Richard?
If we ever have a